As investors, we all go through a learning curve. We get better with experience and learn from our mistakes. But sometimes we don't even realize the mistakes we've been making. And because we don't realize, we keep bearing the cost of these mistakes. Hello and welcome to the ET Money YouTube channel. In this video, we will discuss the key mistakes one often makes while investing in mutual funds and how to avoid them. But before we begin, a quick reminder. If you aren't a subscriber, do subscribe to our channel and don't forget to press the bell icon so that you never miss a video from us. Let's begin. Chasing performance is a mistake most of us have made. I too have made this mistake. After all, it's really tempting to see a fund give high double-digit returns and invest in it, hoping that its dream run will continue and one will earn those returns. Unfortunately, in most cases, it doesn't happen. That's because top performers change every year. Now take a look at the table on your screen. It shows the top equity funds of the last 10 years. As you can see, all sort of funds have been top performers in the last 10 years. There are sectoral funds, thematic funds, small cap funds, international funds and whatnot. Now, if you were going to chase performance, you would invest in the year's top performers, which means a lot of churn in your portfolio. But is this churning worth it? Well, let's look at the data and find an answer. Let's say at the start of 2014, you invested 1 lakh each in the top performers of 2013. On January 1, 2015, you redeemed this money and invested in the top performers of 2014. So every year you kept investing in the top performer of the previous year by redeeming money from the existing funds at that point in time. You kept doing that until 2023. So how would your returns compare with someone who invested 3 lakh in Nifty 50 and Nifty 500 at the start of 2014? See the chart on your screen. For simplicity, we have considered pre-tax returns. So chasing the performance approach doesn't seem to have delivered massive outperformance. Compared to Nifty 500, the extra returns are just a few thousand, and that is before taxes. So if someone had just invested in Nifty 500, he would have done well, minus a lot of action in between. That means no buying, selling, no tracking the best funds, or tolerating the inherent volatility of thematic, sectoral and small cap funds. Let's talk about the Nifty 50 now. There's a difference of about 1 lakh compared to the corpus created in Nifty 50. But remember, Nifty 50 is a large cap index. On the other hand, the top performers were funds that were supposed to have higher return potential, and that's why they appeared in the table you saw earlier. So given that, the difference is not big enough. With the Nifty 50, you would have also experienced less volatility along the way as compared to the other funds. Not to forget that you would not have been required to do anything during the period. You just invested and stayed there. It's like taking 10 different rides to reach your destination faster. But in the end, you realize it possibly was not worth the extra effort. You could have just stayed in the same car and reached just a few minutes later. Now, let's take another scenario. How would the returns compare if instead of Nifty 50 and Nifty 500, you had invested in an index with higher return potential but was more volatile? See the chart on your screen. If we compare the returns from chasing the top performer with the mid-cap index, the difference is huge and in the favor of mid-cap index. Now that means if someone is willing to take a higher risk, going with the plain mid-cap index is far more rewarding than chasing the best performer. Overall, there are better alternatives to performance chasing. If you want to understand how best performing funds change, you must watch this video. Let's move to the next mistake. From time to time, different sectors and themes do well in the market. Now, many investors are attracted to sectoral and thematic funds due to their short-term returns. However, investing in these funds is riskier than investing in diversified equity funds. A major challenge of investing in sectoral and thematic funds is guessing which theme or sector will work. Not many investors can boast of getting that correct. What adds to this problem is that top sectors or themes keep changing. Take a look at the table on your screen. It shows the top performing sectors over the last 10 years. A quick look reveals that the top 3 sectors have frequently changed. So even if you have identified the right sector, there is a slim chance that the sector will remain at the top. Now, you might say it doesn't matter that a sector remains in the top 3. If it keeps doing well, I can continue to make good returns. However, in reality, that may not happen. Take a look at the same table now, but with the following 3-year returns. So for example, if the IT sector did well in 2013, we checked how it performed from 2014 to 2016. If we compare these returns with that of Nifty 50, in over 70% of cases, the top sectors underperformed the Nifty 50 in the next 3 years. Now this suggests that not just the sectors change, but the good performing sectors in a year are often unable to keep up the pace. Now see the top thematic funds and their themes over the years on your screen. Here also a similar picture emerges. The top funds change, so different themes have performed well in different periods. Now, another challenge with thematic funds is that funds following the same theme can give very different returns depending upon how the fund manager selects stocks. Take a look at the table on your screen. It shows the returns of various consumption funds in 2022. Now, as you can see, the returns range from about 16% to -2%. And this trend is not limited only to this thematic category. So, even if you've spotted the right theme, you can't be sure that the chosen fund will outperform. So what should you do? Well, taking calls on specific sectors or themes is not your job as a mutual fund investor. That's what your fund managers do. So if a sector or a theme is up and coming, it will also find place in a diversified equity fund, as your fund manager will pick stocks from it. You don't have to do it yourself. If you do it yourself, you will probably just increase your risk. If you would like to better understand the risks with sectoral and thematic funds, you can watch our video. Now let's talk about the next mistake. Like sectoral and thematic funds, mid and small cap funds attract a lot of attention. In bull runs, these funds tend to give amazing returns, and many investors find that too difficult to ignore. The ongoing bull run is a case in point. Over the last year, as of July 10, 2023, the small cap index is up around 29%. The mid cap index has risen around 27%. During this period, the Nifty 50 has gained about 19%. So it's obvious that people would want to invest in mid and small cap funds. But these funds are not meant for everyone. Only if you are willing to take higher risk for better returns should you invest in small and mid cap funds. Now, if you are someone who doesn't like too many ups and downs in portfolio, you can very well remain with diversified equity funds. Now, to better understand this risk return equation, let's look at the 5-year rolling returns from 2013 of Nifty 50, Nifty 500, Nifty Mid Cap 150 and Nifty Small Cap 250. Now, the mid cap index has delivered the best performance. Nifty 50 and Nifty 500 have done a decent job, while the small cap index has failed to impress. But one should not see returns alone. Returns should be seen in conjunction with the ensuring volatility. If you had to tolerate more ups and downs to get 1 or 2% extra returns, perhaps the extra returns are not that appealing. So how volatile are the indices that we mentioned above? For this, we looked at their standard deviation. The higher the standard deviation, the more the volatility. As you might have guessed, mid and small caps are quite volatile. Notably, the small cap index has proved to be the most volatile and hasn't delivered either. Hence, invest in the mid and small cap categories, especially the small cap ones, only after much thought. A large allocation to mid and small caps in your portfolio can make it swing widely with market winds. If you decide to invest in them, avoid putting more than 30% of your portfolio in them. Now let's move to the next mistake. Yet another common mistake that investors make is that they don't review their portfolio periodically. This is essential. It helps you to cut down risk and problems, and this can help you boost your returns. Let me give you one example from my portfolio. In 2014, I started investing in a tax saving fund. It was doing quite well at that time. For 3 years, the fund outperformed Nifty 50 and Nifty 500. But from 2018 onwards, it started slipping. It has underperformed the benchmark since then. I waited for 4 years of continuous underperformance to stop my SIPs. So finally, I stopped investing last year. I will be able to withdraw from it entirely by 2025. Until then, I'm stuck with it. Now, had I reviewed my portfolio regularly, I could have stopped in 2020 or 2021 after 2 or 3 years of underperformance, and I could have possibly exited the fund entirely this year. My portfolio returns would have been slightly better. But portfolio review is not only about looking at underperforming funds. For example, You can check for exposure to different asset classes when reviewing your portfolio. You see if you have too many funds in the same category. You can even go much deeper to see if your funds complement each other and whether the fund strategy has changed over the years. We recently did a video on why too many funds are harmful to your portfolio and how you can reduce them. The link is in the description. Now, over the years, I've realized that there's nothing called as a perfect or a hopeless portfolio. There are only optimized and unoptimized portfolios, and the difference between them can be quite significant. Let's now see how not reviewing your portfolio can compromise the quality of your portfolio. We all know that the top funds keep changing every few years. A fund giving you high returns for past 3-4 years can suddenly start underperforming, and it can continue to do so for years to come. See the chart on your screen. This chart could be a bit technical. It shows the percentage of funds across categories that have fallen from the top quartile or the top 25% in terms of returns over the last 2 years. To put it simply, it shows how the top performing funds change every 2 years. For example, in the large cap category, most top funds change every 2 years. On the other hand, in the ALSS category, the top performing funds don't change as often in 2 years. So even if you picked good funds, you should regularly monitor your portfolio. Of course, a slight fall in the fund's performance over the short term is not a cause of concern. However, if a fund continues to underperform for 2 years or more, you should consider exiting it. Now, there are tools available on ET Money to help you with this. The fund report card can help you understand whether the fund is worth investing or not. Then there is Portfolio Health Check, which gives you a thorough portfolio analysis, which can be a good starting point. Alright, now let's move to the next point. Many of us start investing right away without first giving a thought to what we need to achieve with our investments. So essentially, we don't have a financial plan in place. Just think of this. What do you do when you have to go on a vacation? You first decide on a budget and a destination, and then you book tickets and stay, and then you look for places you want to go. I don't think any of us steps out of the house not knowing our destination. We just don't end up at the airport with the bags and look for tickets to places we can go on holiday. Now the same thing is with financial planning. Without a financial plan, investing is like shooting arrows in the dark. Even if you do your SIPs diligently and have a long-term focus, you won't know how much to save for which goal without a financial plan. You won't know whether your SIP amount is enough, if you need to increase it, and by how much. Now, another issue is that you won't have an exit plan, which can delay your goals. That's because markets don't know which year you need the money for the purpose you are saving. They will crash at their whim. Let me explain with an example. Suppose you started investing in 2010 in equities, and then in November 2019, you decided to buy a house. By the time you finalized a house, it was February, March. But then in March, markets crashed due to COVID-19. And since your entire money was in equity, a large chunk of your gains would have been wiped away, forcing you to delay buying a house till your investments recover. So to avoid negative surprises at a time when you can afford them the least, it's better to have a financial plan in place. Financial planning has other hidden benefits. It provides a sense of direction and purpose, it keeps you on track, it provides measurable steps, and what gets measured gets done. It helps you stay focused and motivated. Interestingly, a financial plan doesn't start with investing. It starts with building a sufficient emergency fund, which should be equal to 6 to 12 months of your expenses. Then comes health insurance and life insurance. Adequate insurance acts as a shield against life's uncertainties. And then comes investing. Now, how much you need to invest will depend on how much you want to accumulate and what rate of return and inflation are. You can watch our video on key numbers in financial planning on the link given below. It's important to get these numbers right if you want to create a robust financial plan for yourself. Now let's talk about other mistakes you should avoid while investing in mutual funds. So we've covered the key mistakes that investors make while investing in mutual funds. You may already be aware of a few of them, yet it's worth revisiting them. Number 1, investing in regular plans. Regular plans entail distributor commission, and because of this, the fund house has to incur higher expenses. These higher expenses translate into a higher cost you have to pay, which ultimately leads to lower returns. On the other hand, direct plans don't have commissions involved, and so investing in them is more rewarding than it's in regular plans. See the table on your screen. It mentions the difference between the returns of direct and regular plans across categories and how investing in direct plans can boost your final corpus. Now you can invest in direct plans at zero cost on ET Money. You can map your existing portfolio in ET Money app and also convert your regular plans investments into direct plan ones. Number 2, investing in the IDCW option. Formerly called dividend option, IDCW stands for Income Distribution cum Capital Withdrawal. It is an option that AMCs provide if you need payouts from your funds. Now, SEBI changed the names of these plans as their payouts aren't really dividends. What you get is part of your capital and part of your returns back. Hence, the name IDCW. Should you invest in this option? Well, no. The growth option is better as it helps in better compounding of capital. Plus, the payouts from the IDCW are irregular and may be insufficient. They are completely at the AMC's discretion. IDCW payouts are also taxed at your applicable slab. So if you are in the highest tax slab, more than a third of your payout will go in tax. Number 3, investing in NFOs. In a new fund offer or an NFO, a fund house raises money from investors for a new fund. Now NFOs are launched at an NAV of 10 and some investors mistakenly believe that a lower NAV means a cheap fund and it will lead to better returns. First, one should avoid investing in NFOs as these funds don't have a history. It's always better to get a fund that has proved its worth across market cycles. Second, don't think that a low NAV means a cheap fund. NAV itself doesn't make a fund cheap or expensive. Neither should you compare a low NAV with a high NAV of another fund and think there is an ample scope of NAV to grow. The NAVs of the two funds are not comparable. It's not the NAV but the change in NAV that contributes to your returns. Number 4, investing short-term money in equity. When the markets are in a bull phase, many investors want to ride the wave. Some investors also see the historical short-term returns of funds and get carried away with their 1 year or 3 year returns. Remembering that past performance doesn't guarantee future returns is worthwhile. Also, one should see the worst performance of a fund over 1 year, 3 year or such periods to get an idea about what they can lose. See the chart on your screen. It shows how many times various indices made a loss over a 1 year period. While Nifty 50's numbers still look respectable, mid and small caps exhibit a higher chance of giving you a loss in the short term. With small caps, it's almost 1/3 probability. So never invest in equity for the short term. Keep at least a 5-year horizon. It's better to keep a 7-year horizon for riskier categories like mid and small caps. Keeping this horizon will ensure a good return experience from equity. With this, we have come to the end of the video. If you like the video, do share it with your friends and family and do subscribe to our channel. We will see you again very soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.